previous high. Of course, I mean, the Bank Nifty did not fall as much as the Nifty did. This entire decline, it's the fastest to come back, and we'll put that alert out in just a bit. Mid-cap index is up about 0.6%, 300 points higher. You've got, we've opened at a record high, so we should change that to, not set to open, but opens, basically. We got the other indices, the small cap index, which will come up, which is also higher. And it's an all-round good start, which is coming through. Market breadth, very, very early, just out of the gates. But, it's 1,000, 1,100 stocks are higher, 400 stocks are lower to begin this week. Rima.
Well, the Nifty is inching towards 24,000 level at open. And now all eyes will be on the 200-day moving average is 24,050. We've extended our rally for the 5th day in a row, and what's helping is positive earnings from the banking names. Perhaps all the bad news is in the price for IT names for now, because the Nifty IT index has also opened up in the green with a gain of about 1.7%. In fact, sectorally, IT is the top gainer. It's Nifty IT 1.7% higher, followed by Nifty Bank with a gain of 1.3%. Very close now to that 24,000 mark level, just 12 points away. The top gainers include, in the large cap pack, actually the first three are IT names. So it's Tech Mahindra and HCL Tech. HCL Tech reports numbers tomorrow. Stock is up nearly 2%, and Tech Mahindra towards the end of the week, and that's the top Nifty gainer, 3% up. Infosys is higher. Infosys is opened with a gain of about 2.5%, so that's advancing. Remember, the stock had declined 24% since the start of the year, and analysts are pointing out that the guidance of 0 to 3% for FY26 is not as bad as what was feared last week. Following IT, you've got the banking names. It's a stellar performance by ICICI Bank. Brokerages are raising their EPS estimates. Stock is opened with a gain of 1.5%. HDFC Bank giving it company, and both HDFC Bank and ICICI Bank are at fresh highs. HDFC Bank inching towards a 2% gain. Axis Bank. In fact, if you look at the top 10 gainers, it's all IT and financials. So you've got, we spoke about some of the others. Some of the others included State Bank of India, Shriram Finance, Wipro, IndusInd Bank. IndusInd Bank continues with its rally from last week. This month now, IndusInd Bank has gained 24%. On the way down, it's Adani Ports. There is that acquisition that's weighing. Stock is down 3%. And then some FMCG names are weighing on the market. Tata Consumer, Asian Paints under pressure, Nestle, ITC down nearly 0.5%.
All right. In broader markets, actually, the market breadth would have you believe that 4 out of 5 stocks in the markets are in the green right now. So for every 1 stock which is in the red, we have 4 in the green. We have a bunch of stocks which are actually doing well, and a lot of them having news backing them. So Yes Bank up around 6%, reported its numbers. The deposit momentum was strong, as was the advances, close to around 8%, which despite being slightly lower than the provisional update, the street's taking that with both hands, up 6% for that one. GAIL up 4%. Sudarshan had told us that, the PNGRB has, released a consultation paper for revision of tariffs, so that could be a positive. GAIL is up 4%. We have Just Dial as well. Even, the revenue growth was slower, 0.7% quarter on quarter, a 7% move year on year in terms of revenue is has the street excited on Just Dial. Has been a beaten down name, up around 7% as we speak. Devis Labs is the one that is higher from the pharmaceutical pack. This after inking a drug supply agreement for which they will have to invest about 650 to 700 crores in capex. Oberoi Realty is of the 5 stocks, 1 in the red. Oberoi is one of them. Its fourth quarter bookings were down nearly 52%. FY25 booking value was up 31%, though the fourth quarter being weak has the street worried a little bit. The stock down by about 1.6%. But by and large, a fairly strong looking screen. We have Intellect Design Arena, Oracle Financial Services, Devis Lab, Bandhan Bank, Coforge, financial and IT in the mid-cap end of things doing extremely well as well. And then we have a couple of these names which continue to move in the direction that they've been moving in the past. Senco Gold, for instance, up around 5%. We're seeing some traction on the way up for names like Northern Arc and Kitex Garments as well. But on the way down, we have Gensol, which continues to decline, 5% lower today as well. The stock at 111.
Well, lots happening. Infi is now lost pretty much all of its gains. I mean, not all, but there's about $10 left on it. And I would say rightfully so. I mean, for the stock to open 3% higher, could have started flat and then gone up. But to open 3% higher, I think it would invite at least traders would want to take a punt that the numbers are bad, the outlook is not all that rosy. I think just some trading action going on here more than anything else. But there is, of course, a lot happening otherwise outside of IT. And I think we mentioned bulk of it. Divi's, of course, 4%. It's got very large volumes. Yes Bank is up 5%. Yes, with 5% is the largest volume-led gainer right now. And there is Axis, which is up 3%, 1,227. Actually, Axis is the number one volume-led gainer as far as the market is concerned. There's Kiri Industries, which is up 5. Inox Wind is up 4. Just Dial, I think we mentioned, 8%, big volume gains. Ujjivan Small Finance Bank is up about 4%. Supriya Life Sciences, Senco Gold, and so on and so forth. But things are just picking up as far as volumes are concerned out here. Adani Ports with a 2.25% loss is the number 2 volume-led loser right now. So 1,230 on Adani Ports is what we've got. And the big winner from last week was Goldium. I mean, big 250 to 350 very quickly in about 4-5 days. That's starting with about a 2.5% cut. There's Shelly Engineering. I mean, it's there are institutional investors here. It's down 7%. I'm not sure if there is any specific news flow here. Volumes are very, very thin right now, but 1710 or so is where Shelly is now coming in at. 95 on the Nifty, 23,950 on the index. Pankaj Murarka is with us with what he's making of the market, CEO and CIO at Renaissance Investment Managers. Pankaj, good to have you back here on the program. Prashant this side. Thank you for joining us. The Bank Nifty is at a new high. And hopefully this time, last time the 23,800 breakout in the Nifty did not last. Maybe it will now. Mood's pretty constructive out here. What are you doing, Pankaj, at Renaissance? And just tell us your outlook, near to medium term.
Sure. Morning, Prashant. Always a pleasure talking to you. I think, Prashant, we broadly remain constructive on Indian markets. We've held that view. I've held that view that whatever correction or pullback we've seen in the last 5 or 6 months, it's been more of a bull market correction than a change in broader trend on the market. The fact remains that we are coming out of a cyclical slowdown in the economy last year, where last year, if you look back, the March ending FY25, Nifty 50 earnings growth is just about 5%, probably the slowest earnings growth that we've seen in the last 5 years post-COVID. But I think that's in the base. Probably from here on, we'll see gradual improvement in earnings. Obviously, the world has seen that what lies ahead for the world is trade headwinds, significant trade headwinds. But probably in an environment like this, India is a relative winner because India is tariffed much lower than a lot of other competing economies. So that should help India slightly more medium term to long term. So our view overall remains fairly constructive from a broader market perspective. I think probably we should moderate our return expectations, but I still firmly believe that probably before the end of this calendar year, Nifty will make a new all-time high. So in that sense, we continue to remain positive on the markets.
What are your thoughts on IT? That's been the biggest drag since the beginning of the year. Growth is slowing down quite dramatically. But valuations too have corrected. And now some of the stocks like Infosys, for instance, is at its long-term valuation multiple. What's the call on IT, mid-cap and large-cap?
Well, as you rightly said, Rima, valuations have corrected and are pretty much, at least in the large cap companies, are closer to the levels where one would ideally want to invest into these companies. Having said that, we should concede that given the significant amount of uncertainty and these companies have called out that clients are holding back decisions. The biggest damage, I think, apart from everything else, and uncertainty around tariffs and what it does is it shakes CEO confidence globally. And once confidence of the CEO is shaken, obviously all investment decisions and everything is pushed back, and which is what these companies have even called out and they're experiencing where large deals or discretionary spends are pushed back. So I clearly think that the growth in the near term, at least over the next few quarters or probably next year, is impacted for the IT companies in that sense. There's a lot of fog on the windscreen and there's uncertainty. So until the fog is cleared, unlikely that we'll see these stocks performing. Having said that, as we said, in the large cap, at least valuations are far more reasonable or probably have become attractive. Some of the large companies are now quoting out or trading at dividend yields or free cash flow yields or earnings yields, which are as good as 5 or 6%. So probably that's the floor in terms of valuations for these companies. So I think it's time to selectively nibble, but I still think stock price performance probably would be more back-ended towards the second half of the year once fog on the windscreen is cleared.
Same of the consumption space. Valuations are not at long-term averages. They're still slightly elevated. And those long-term averages as well in the consumption space are elevated. A lot on the street believe that maybe the earlier axiom of FMCG stocks trading at a much higher multiple than the other parts of the market needs to be revisited. But on the ground, there have been signs of some recovery, especially on the rural front, and maybe some bit of incremental recovery coming in from the urban front as well, largely on account of all the SOPs that the government has given on the budget, etc. Do you believe that maybe some of these erstwhile companies are now taking charge, also looking a lot better than the D2C competitors, which have faced some sort of liquidity crunch?
Absolutely, Nigel. So I'm pretty positive, constructive, bullish, whichever way one way to frame it on the consumer stocks. Meaning, I think it's one sector which has underperformed big time in the last 5 years. If you look at post-COVID stock price performance, this is one of the biggest laggard sector. But I think after 5 years, we're getting to a stage where we are seeing early signs of recovery. And I think we are in for a very significant or meaningful recovery in consumption in the Indian economy over the next 2 or 3 years. Also, in a world where global trade is going to shrink, given that the largest buyer in the world, US, is going to withdraw, I think every economy or every country will have to look inwards towards driving growth. In India, we have stars aligning for a recovery in consumption sector. One, we're coming out of a very low base of consumption in the last 2.5 years, where the PFCE, or as we call the private final consumption expenditure, growth has been about 5%, which is half of the long-term growth of 11.5%. More importantly, the government has done tax cuts in the last budget. That money will flow into the pockets of consumer. I think we're looking forward to a GST rationalization, which will again reduce GST tax on certain category of goods and again benefit consumption. And also, I think the rate cut cycle should also benefit consumption. So all of that, sum total, I think will lead to a meaningful recovery in consumption. So we remain pretty constructive. I think the two big sectors that I really think can outperform the market over the next 2 to 3 years is essentially private sector financials or financials broadly and consumption. So both these sectors have been laggard over the last 2 years, but I think they could be the leaders in this rally going forward as we build on this bull market from here on.
And how do you play consumption? Via traditional FMCG names, rural focused, urban focused, or discretionary names, or maybe entry-level auto names as well?
Well, given our growth bias for us, the natural bias is focused toward discretionary consumption. So we like names, and we own in our portfolio names like United Spirits and Jubilant Foods, to name a few, which we think will benefit as we see an uplift in consumer spending. But I would also say at this point of time, we're also buyers of staples as well, because for the very simple reason that we're coming out of a very low base of consumption over the last 2 years. When I said that, if you look at last 15 years, the aggregate private sector consumption or household consumption in India has grown ahead of nominal GDP growth. In the last 2 years, that growth is like half of nominal GDP. So because of very sharp inflation spike that we saw in the economy 2 years back, consumers have cut back on spending, including on staples. So now that inflation is moderating and there's rise in income levels, I think first thing the consumers will buy into is staples. So I see a very strong volume recovery in staples as well over the next 12 to 18 months. So at this point of time, our natural disposition is to own consumption across both staples and discretionary.
From your published portfolio, Pankaj, if you want to sort of talk about 2 or 3 ideas with full disclosure, what you're most constructive about, Pankaj, across the board. I mean, private, I understand financials and consumption, and we got into some detail there. But if you want to sort of talk about, overall, what you're most convinced about.
Yeah, so in a slowing economy where growth has moderated, I think the natural disposition for a growth bias investor like us is to look for outlier growth, which are the pockets of the economy where the growth can be significantly higher, and probably where can we make outlier returns. So clearly from our point of view, one we clearly see is capital markets or financial services as a sector which has strong drivers supported by savings and money moving into capital markets. So we own HDFC, AMC, and Motilal Oswal Financial Services to play the capital markets play. I continue to remain very constructive on the fintech opportunity in India. I still believe that 10 years out or 15 years out, one of the top 5 financial services company in India will be a fintech. And we've been holding Paytm for a long period of time. So I still continue to remain constructive. I think over the next 5 years, Paytm could do $1 billion of EBITDA. And I think some of these companies can actually lead to some outlier returns over the next, let's say, 1 to 2 year time horizon.
That's important. We've got
As
to-
you rightly said, we own all of this in our portfolio, so the disclaimer
Yeah.
follows.
No, full disclosure, absolutely. But good to put some names, right, to some of the ideas, as always. Pankaj, thank you very much for joining us. By the way, we have another fintech coming up in the next conversation, so you may want to listen in. I'm talking about Angel One, which is, of course, a capital market play, but of course, expanding into many other areas as well within the capital markets and wealth management, etc. as well. Pankaj, thanks very much. So let's get to it. Mangalam, Angel One.
Angel One, the stock's actually done well. In fact, over the last couple of trading sessions, the result was weak as expected, largely because of the weakness that we're seeing in the market itself. The sort of regulatory issues that came by in the F&O space led to their F&O volumes declining by about 26% as well. Overall, there was a decline in their revenues. Let's decode the trends of the future with the company. We do have with us Dinesh Thakkar, who's the chairman and managing director. Remember, the stock from a technical standpoint did come out of the F&O, did enter the F&O ban as well, which explains the sort of up move that we're seeing out there. Thanks a lot, Mr. Thakkar, for joining in. Two things that I want your thoughts on in the very near future. One, you said that things are normalizing. You expect the margin band to return to that 40 to 45% by the fourth quarter. What gives you the belief that it will go there? Secondly, even as there was an impact in the F&O business because of regulations, it seems like you lost market share. So the impact was a little more on Angel One versus the others. What explains this?
Okay, first of all, what I had said, we will return back to kind of like normal financial ratios, that is OPM and all that, by fourth quarter, not first quarter.
Fourth quarter itself.
Of this fourth quarter of the financial year. So we have gone, I would say this industry has gone through a kind of a like perfect storm where whatever should go against this industry has gone. Macros, be it our economic growth, be it FIS not investing, and majority impact is because of regulatory changes, which has now, I would say, absorbed by retail investors. We saw a bottom in terms of number of orders in Feb. We did almost below 50 lakh order per day, which is kind of like minimum. After that, we are seeing slowly kind of like revenue curve is moving up. So March numbers were better in terms of 53, 54 lakh order per day. And we are seeing this trend continuing in the like this month also. So that gives me confidence that, okay, at least revenues are now, revenue come has turned for better. And margin expansion in digital company, what happens when we take a cost to build a platform? There is a cost to build a platform and maintain the platform that we have already taken. So today we have a platform which can serve an order up to 1 crore 40 lakh without much increment in cost. So whatever revenue increment we see in this progressive months, that will straight away contribute to our expansion of margin.
Mr. Thakkar, morning. This is Rima here. Could you give us an indication of what the current orders per day are? February was sub 50. In March, it was averaging 53, 54. What would it stand at? And what was the peak or the average, say, when things were going, all right for the markets?
So average number of orders that we were clocking was around 75, 78 lakh per day. So today, as we speak, like last March number, we have already disclosed that it's around 53 lakh plus. So that trend is continuing. So we don't disclose all this number. So maybe by month end, we'll disclose this. But I can say that a positive trend that started in Feb continues.
Okay. What about your F&O market share? Have you lost market share? What does it stand at?
Yeah.
What would you attribute it to? And what steps are you taking to correct it?
Yeah. So what happens when actually we talk about market share? Market share in retail comes from Ultra HNI, retail, prop desk and all that. So when we lose market share, it is that retail is less active. So you will see market share dipping a bit. So it is not a point of concern if you see a graph of like 12 months, 24 months. few months there would be some dip because retail is not participating as actively as HNIs are participating. So it is not a matter of concern for us. We are seeing overall other parameters in terms of engagement on our platform and all that. We are seeing engagement of these customers is equal or better than what they were a few months back.
Mr. Thakkar, hi, good morning. Prashant this side. On the F&O side, sir, and we asked this, we put this question to exchanges as well when we get the opportunity. Could you give us, again, same kind of comparison? What was the high there in terms of F&Os on a metric that of your choosing? Where are we now? And just to give us a kind of a scale comparison.
So, like in terms of number of order, this quarter, we degrew, our growth was like lesser by around 21-22%. So overall, whatever impact we have seen in terms of F&O order, on month basis, I am seeing a growth of around 6 to 7% now for this past 2 months. So that gives a broad sense that, okay, retail are coming back. See, for retail, there was no reason for them to come back because markets were depressed. They did not see any opportunity and they were not in a hurry to really jump and decide that what kind of an instrument they had to buy, if at all not options. So what I am saying after this kind of like stabilization in terms of our kind of like news that are coming and the FIs inflows that are coming in, it appears that retail is getting back confidence to come back to the market. So what we are seeing, if at all this trend continues for few 9 or 10 months, and customer growth rate that we are seeing, we are able to acquire in this bad condition also a customer base of around 5 lakh, 6 lakh per month, that will all contribute to expansion in margin in next 9 to 11 months.
You know, Mr. Thakkar, just to, and we'll sort of summarize this with the overall numbers as well. You've been very aggressive in terms of, by the way, Nifty has hit 24,000, Mr. Thakkar. So, you know, that's talking directly, that's talking directly to your business. I mean, things have got to look up, right? I mean, it's just the way it is. For retail to come back, for optimism to come back, and of course, I mean, that is a direct impact on order flow, order volume, etc. So for now, 150 odd points in the Nifty, by the way, so 24,000, Nifty Bank hitting a new all-time high. So things are looking better, of course, much better. Mr. Thakkar, on wealth management, right? I think you've been, of course, you launched and you're growing rapidly. Could you give us a sense of what are you doing? What should the growth in AUM be? You know, what are your targets for the end of FY26, say?
See, fortunately, we got a good team to manage our wealth business, and we were able to recruit top-class kind of like relationship managers and all that. And we just got licensed few months back, and in few months we were able to get an AUM of around 3,700, of which 3,200 is asset under management. So difficult to set a target for this thing. So usually the way we function is that we are building a base right now. So what is important right now is that all processes are in place, kind of like relationship managers, they are aligned to products that we want to sell. So I am seeing a good acceptance of our products in the market. So we are very bullish on that vertical.
Right. You know, Mr. Thakkar, as we speak, well, the Nifty is above that 24,000 mark. The IT pack is coming off lows. The Nifty Bank doing well. Reliance is the one which is powering that index ahead right now. Reliance reports its fourth quarter numbers on Friday. So we have Reliance, which has moved to the high point of trade as well. So that's about the market. Coming back on your customer addition, metric that you spoke about. In this market, you're able to attract around 5 to 6 lakh customers per month. Your customer acquisition costs have increased as well. So from the peak to now, how much do you think your customer acquisition costs have increased? And with retail perhaps likely to come back because the markets are making a comeback as well, how much would they reduce by? If you could give us a comparison on that one. At the same time, the revenues per order. In F&O, it has been coming down to around 21.2. And cash, it's increased to around 11.8 rupees per order. What's your outlook on these?
Yeah, on cost, there was a slight blip in the month of Feb and March. That is usually seasonal, and even Google has increased the prices. So we have brought that cost back in this month. So now it is again back to normal. And plus, as market were subdued, so definitely to acquire a client, it is becomes a bit costly. with market returning back to momentum and all that, we believe we would be able to get to the similar cost of acquisition what we had for past year. And on F&O volume, revenue and all that, again, it is a function of market. Once you see volatility and momentum in the market, lots of retail will come back and you will see that order, revenue per order would almost come back to normal. On cash side, because lots of people who stopped dealing in option because of ticket size increase and all that, they have come back in cash and they're doing margin trading and all.
All right. And finally, on the commodities front, your business declined 4%. It was explained by a high exposure to oil. But, now gold is doing extremely well. Are you exposed to that? And would we see an improvement in your commodities business?
See, what happens when we talk about market share of overall basket, it contains oil, gold, silver, and all that. But retail tends to be more active when oil is active, and retail tends to be less active when gold is active. In gold, I think mostly HNI, ultra HNI would be taking a big kind of like calls and all that. So whenever this kind of like balance changes favoring precious metal and all that, you will see some dip in our market share.
For the year, Mr. Tucker, for FY26, right? I was looking at some estimates. They are projecting a small, single-digit decline in top line and a slightly larger decline, but single-digit decline as far as bottom line is concerned. Should we work with those kind of expectations, a subdued 26? What's your sort of sense?
See, FY26 this year would be a year of consolidation where we would be focusing more on getting back to OPM, and the growth is going to help. So currently we are not working on what kind of top line we will achieve because it's a function of market condition, lots of things. Internally, what we can do is that, okay, how do we bring in AI tool, get more cost efficiency, and how do we bring in more customer on our platform? So result of that, whatever revenue we are going to get, it is very difficult to predict at this point in time. But what we are confident is that we would be able to bounce back to an OPM of 40-45% by Q4 FY26.
Okay. All right, Mr. Tucker, we'll leave it there. Good conversation as always. We wish you all the best of luck and we'll continue to touch base with you over the next few months and quarters as well. Thank you indeed. I think the market's up 160, holding 24,000. Time for a quick commercial break. We've got a discussion lined up on, of course, the trade negotiations, US-India bilateral trade talks in focus. You also have the US Vice President J.D. Vance arriving in India for a 3-day visit. All of that in focus on the other side. Welcome back. Markets doing well. 24,000 on the board on the Nifty futures joining us. Nifty Bank making a new all-time high. And of course, at the margin, there is everyone keeping an eye on the trade negotiations, which are due to kick off. I mean, at least to finalize the outlines of what final negotiations will look like. I mean, the topics that need to be covered in those negotiations. Well, we also have US Vice President J.D. Vance and his family in India on a 3-day visit. They're going to be in Delhi, they're going to be in Jaipur, they're going to be in Agra.
Okay.
Your mic, Prashant, I think fix that. So we'll just keep an eye out on that. Those visuals coming in. That's the official airline of the United States of America. They seek to unlock economic opportunities, like it was said, to negotiate a bilateral trade deal. Let's see. We'll get the first visuals of J.D. Vance and Usha Vance off that plane right now. I reckon, it's when it's the vice president who travels. It's called the Air Force 2 and not the Air Force 1. So not sure the nomenclature that one has to use for that airline out there, but shortly enough we'll get the visuals.
By the way, Mangalam, I got my mic back, and kids as well. I mean, I think it's a full family visit.
But it seems like it's more of a cultural trip.
Yeah,
like, of course, there is going to be bilateral trade negotiations. There is a state dinner with Prime Minister Modi, but I think he wants to show.
I'm not sure, but I think this trip was planned before the election. I think because, or maybe now, of course, he travels in his capacity as vice president. But there you go, full, of course, protocol, etc. He's coming in, I think, at the Hindon Air Base, from where I think he'll travel to Delhi, and where, of course, I mean, there'll be official meetings, etc. I think there's a meeting with Prime Minister Modi later today, and then I think that's a Palam Airport, beg your pardon. And the team coming down, we should have the first pictures, first visuals coming through in just a bit from now. So we'll keep those visuals at the side of the screen, and we'll sort of talk about this and as those pictures start to come in. Well, let me welcome in Ajay Sahai, Director General and CEO at FIEO, and Anup Vadhavan, former Commerce Secretary, Government of India. Gentlemen, good morning. Great to have both of you here. Prashant this side. Mr. Vadhavan, if we can start with you, sir. This visit, of course, is coming at a crucial time. Of course, I'm sure trade talks, etc., will come up, but we don't know in what capacity, how will it happen. But my question to you, Mr. Vadhavan, is that US team is in the US this week, and there are going to be discussions. So how will this, in your opinion, work? There are these reciprocal tariffs which have been put on hold for 90 days. There is that, and then there is a trade deal. So when these discussions happen, you're discussing what? Because 8th of July, if nothing happens, these tariffs come into force again. So you've got to avert that. But obviously, you can't get a trade deal by then. That's only by fall. So how will this work out?
That the level of the Vice President, Mr. J.D. Vance, will be at a broad level. As far as the trade agreement is concerned, I think much ground has been covered. Looking at press reports, I think both sides have worked out the broad framework. There is some talk of a 19-chapter agreement. There is talk of a phase 1, which will be completed by September, October, I think covering the goods part, and a phase 2, which is supposed to happen after that, which I think will cover services and other issues. And within the phase 1, the goods part, there is talk of an early harvest within 90 days. So that will happen even before September, October. So I think much ground has been covered, and I think both sides seem to have developed a certain comfort about these negotiations, and I see them happening smoothly. As far as the Vice President's visit is concerned, I think that the discussion will be at a broader level and will go beyond trade. And then we must not forget his India connection. I think his India connection would have been one reason for him to be very keen to make this visit. So I think we have to see the thing in totality.
So this visit aside, as far as negotiations, you're saying that there's, from what you sense and what we read, etc., there seems to be a broad agreement on what all needs to be on the table, which needs to be up for discussion, right? Because we are at that stage here.
Right. So there is always a framework agreement you have when you start a trade negotiation. So I think that framework has been broadly worked out. All the timelines have also been worked out. And I'm sure there'll be an understanding on both sides as to what each side has by way of wants, what each side has by way of sensitivities. So I see a fairly smooth negotiation happening. And I think over the years, we are quite clear as to what are the aspirations the US side has in terms of goods market access. We are quite clear about what aspirations India has in terms of goods access and in terms of our services ambitions, especially our IT businesses, etc. So I feel very hopeful that we'll be able to.
Yeah. According to you, what would be the ask from the US side? 3 or 4 most important things.
Yeah. So clearly, is it for me, the question?
Yes, it's for you, sir. Mr. Vadhavan, go on.
Clearly, autos, both four-wheelers, two-wheelers, including electric vehicles, uh, items like ethanol, items like wines and bourbon and other alcoholic beverages, dairy and agri products certainly will be on the request list. So I think these will be the basic asks on the US side, and our asks are also quite clear. Textiles, gems and jewelry, leather products, our engineering products. Because pharma, they don't face very high duties, but pharma, there would be requests for facilitation in terms of regulatory approvals. Those take a lot of time sometimes. So I think both sides have these fairly well understood asks.
Okay, I think those are pictures coming in. First pictures coming in, JD Vance and Usha Vance coming down the stairs there. And, so first visuals are coming in at this point in time. And by a protocol, you've got, him being welcomed. I think that's Ms. Ashwini Vaishnav welcoming sort of Vice President JD Vance and visuals coming in as we speak. So that's from the Palam Air Base at this point in time. All right, Mr. Vadhavan, I'm going to come back to you in just a bit because I want to ask you whether what you said, right, from the US side, agricultural products are going to be hard to do, and also there are tariffs, but there is also market access, etc. Right? There is the issue of VAT, for example. Which I don't know if that'll be contentious, etc. So just coming back to you, but let me get in Mr. Sahai into the conversation. Mr. Sahai, I was looking at this data and I put this data out in the morning as well. This is from a firm which tracks container shipping around the world, about 65% of it. So it's a pretty good data set. And their data shows that US imports in the first week of April as compared to the last week of March, imports into the US fell 64%. Exports out of the US fell 30%. This is week on week. But this is first April data, and there would be that element of, getting shipments through before those, before that 2nd of April deadline. So you'll have to adjust for that. But this is still very large impact in that sense. Could you give us a sense of what the situation is out of and into India? What's the feedback you have?
In fact, so far the imports into India is concerned, that's not much impacted. On the export side, since we have 90 days pause period, companies are trying, and in fact, buyers are also insisting that they should ship the goods because there is certainty on the tariff front, at least in the 90 days. Nobody knows within 90 days whether BTA will be concluded, whether there will further deferment or the reciprocal tariff will come into effect. So probably there will be some front loading, which was there earlier also. Probably that may continue, subject to availability of inventory and also the production cycle for number of products. So as of now, both the sides are trying to push within the 90 days. And at the same time, we are hoping that, as told by Mr. Vadhavan, we may have at least first tranche with reference to the tariff negotiation, and we can take other issues subsequently, because as of now, the tariff is the priority.
Mr. Sai, what you're saying is, so anything that you're agreeing to in terms of contracts, etc., exporters and otherwise, July 8th seems to be the outer limit for now, right? That's the 90-day deadline.
No, that's true, because up to 90 days, we know there will be only the MFN plus there will be a baseline tariff of 10%. Nobody knows. So it's not that the Indian exporter, even the foreign buyers, the US buyer, they're also looking from that perspective. Because if the duty goes, let us say, to 26%, they will also require more liquidity, as the duty has to be paid upfront at the time of clearance of shipment. So they have to have the excess liquidity at their disposal also. So to the extent possible, both sides are looking into whether they can push the shipment within 90 days. If it is not possible, and we will see what happens there. We are also hopeful that at least some relief to India will come, as we have the early mover advantage. We are already negotiating the BTA, and we hope that at least the first tranche which relate to tariff, or if not, the early harvest will be in place to take care of the lower duty on the Indian exports.
And in terms of sectors, Mr. Sahai, you heard Mr. Vadhavan, textiles, gems and jewelry, What specifically, according to you, should be in focus as these negotiations go through?
In fact, our focus should be on the product which we are exporting to the US, and also the number of product where shift from the market from China will happen. We did a study and we observed there are 175 tariff lines at 6 digit, where India's export to the US is roughly 50% of the total export in respect of 175 tariff line, and so is the US. So that can also be a priority area. We have to look into our existing product of exports as well as the potential product of export to get the duty relief for them.
Mr. Vadavan, you briefly mentioned in terms of US's demand, agriculture, horticulture, etc., right? Would that be a problem?
I don't think it will be a problem. There have to be available deal with sensitivity. You typically have staging of duties so that you shouldn't come down immediately to zero, or it comes down to a moderate level over a certain period of time. You have things like tariff rate quotas, where you restrict the quantity which comes in, and you have maybe a moderate duty, not a zero duty. You have things like minimum import prices, only the higher end dairy products, higher end, wines, etc. can come in so that they serve a separate niche and they don't threaten the Indian domestic manufacturers. So I'm sure they'll find a way out. As you mentioned, the main thing will be the SPS protocols, sanitary and phytosanitary protocols for agricultural produce and dairy produce, which are very important in the interest of human health, animal health, plant health. So those are important. American dairy products have this issue of, the cows being fed with sort of animal-based feed. So that is a issue with us. It's a cultural, socio-cultural issue in India. We've been opposed to having dairy products where the animals are fed with animal feed. That sort of undermines the concept of milk, being vegetarian and dairy products being vegetarian. So we'll have to find a way around that problem. And last time we were discussing with the US, some methods were being found, to have ring-fenced production where the animals are not fed animal-based feed. So I'm sure there are mechanisms available for dealing with those problems. We're going to have to deal with them also with EU. We'll have to deal with them when we're negotiating with UK. So these mechanisms are, I think, on the table.
That's a very interesting point, which you bring up, and there'll be so many of these sort of specific things, right, which will come up across various product categories, but very interesting. We'll leave it here for now, Mr. Vadavan and Mr. Sahai. Appreciate both of you joining us, but we'll invite you back as we get more information in terms of how these negotiations, these talks are proceeding, and continue to get more perspective as well. We'll go across now to our segment, Quarter Se Quarter Tak. We are getting you expectations from one sector every week. And today we have expectations from the NBFC space. Abhishek is standing by, and then we'll get into a discussion. Abhishek, lay it out for us.
Well, Prashant, to begin with, NBFCs could see seasonal tailwinds amid selective stress in Q4 FY25, and they are likely to see peaking of cost of funds for them. So seasonal positives to support is the growth. Q4 is seasonally a strong quarter for NBFCs with improved disbursements, recoveries and collections as well. So tailwinds to asset quality is expected, aided by government project payouts, better winter crop yields, as well as the fact that business team incentives are there in place. So net interest margin is likely to remain comfortable as 15 to 20% of borrowings are repo linked, and they may offer a cushion despite a rise in cost of funds which are nearing the peak right now. Now stress pockets show signs of stabilization as well. Early signs of breather in stress segments such as unsecured loans and microfinance is seen right now. So management commentary will be the key gauging factor to see if the stress has peaked or not, especially in the unsecured and MFI portfolio, that is microfinance portfolio. Selective weakness will persist, like muted disbursements is expected in prime housing loans, vehicle finance loans and unsecured or personal loans. tightened due to recent regulatory scrutiny that we are seeing. Now, housing loan disbursals is expected to be impacted by registration-related issues in the cities of Bengaluru as well as Hyderabad. Collections and recoveries will set to improve in this quarter, given the fact that seasonal pickup is always seen in Q4 with respect to collections driven largely by the Rabi or winter crop, realization, government project payments, and target-driven efforts by sales or collection teams. So credit costs will remain high for the players in the microfinance sector in Q4 of FY25. On your watch list, large H1 FY25 slippages likely to stay sticky for the lenders, with full recovery potentially slipping into H1 FY26. Now, close monitoring of commentary on stress levels in unsecured and microfinance portfolio will be critical to watch out for. Some key estimates that we have from Kotak Securities includes Bajaj Finance reporting a YOY growth in NII by 22% and PAT up 18%. Bajaj Housing Finance NII up 34% YOY and PAT up 61% YOY. Chola Mandalam, they expect NII to grow by 30% YOY and PAT to be up 20% on a YOY basis, while for Muthoot Finance, Kotak Securities estimates NII growth of 35% YOY and PAT growth of 43% YOY. Spanna Spurti, Motilal Oswal estimates NII to decline by 13.4% YOY, while they can report a loss of nearly 414 crore versus a profit of 129 crore in the same quarter last year. Back to you.
Thank you very much for that. Digant Haria is now joining in. He's the founder at Green Edge Wealth Services. By the way, look at the Nifty Bank go. The Nifty Bank is consolidating its hold above 55,000. It's 55,200. It's a new record high for the Nifty Bank, even for ICICI Bank, HDFC Bank. And Hormus points out that in the last 25 trading sessions, from the March 11th low of 47,700, the Nifty Bank has scaled close to about 7,000 points. Digant, it's only getting stronger, especially for names like ICICI Bank and HDFC Bank. Before we get chatting about NBFCs and the expectations, first come in on the numbers that we've seen from these two large private sector financials.
Yeah, morning, Rima. See, ICICI continued its streak of very strong numbers. But if you just see, their loan growth has been a little bit tepid. Everything else is spick and span. And if you look at HDFC, you can actually see something reverse, that, the loan growth has probably not picked up, but margins have started to improve. So I think it is just telling us one thing, that probably ICICI Bank is at the best of its performance and HDFC Bank is at the worst of its performance. So, if I look at next 12 months, I think a switch trade from ICICI to HDFC will do a lot of good to investors. At least that is what we see it.
All right, let's talk about the NBFCs now. At a time when, there are private sector banks which are looking up, the rate cycle is on the lower end and consumer sentiment seems to be improving. Where would you, place your bets in the NBFC space? Do you think they're likely to outperform growth when it comes to their bank counterparts, or do you think NBFCs still have a couple of quarters before they outperform banks?
Morning, Mangalam. See, I think NBFCs also, you can see a very similar pattern. Let's see, all the top quality NBFCs have already made lifetime highs, and they're pricing in a lot of good things which will come in the next 12 months. So something like a Shriram, Chola, Sundaram, Bajaj Finance, I think a lot of up moves have already been made. It's not very easy to see big up moves because the earnings are not going to surprise in a materially big way, because, in the previous show also I said the PSU banks are alive and active and the competition will be very high. What we are seeing is, some bit of easing of the last 12 months. So I would think that in the NBFC space, you should play the other segments, not the very high quality segment, because there a lot of the upsides have been captured. And, I was just watching QSQT, what Abhishek was saying. So this quarter, we should do something different, in the sense, the segments which will give very good results are probably the segments which are going to peak out. They will not give great returns or great upside in earnings. So vehicle finance is one where we think we have peaked out in terms of the cycle. And gold finance also, because of the regulatory guideline, both these sectors will report very good numbers. But that very good numbers should not be treated as, what will come in the next 12 months. Next 12 months can be a little softer. Whereas, in sectors like, say, microfinance or personal loans and personal finance, I think the stress will bottom out either in this quarter or the next quarter. So we will actually be very watchful in places where results are bad, because if the commentaries are good, we know that we are probably at the end of the stress cycle.
Any particular picks in the microfinance which are close to bottoming out or may bottom out in Q4?
So I think there is a huge buffet available. Banks like AU Small Finance Bank or Equitas and an Ujjivan in the bank, small finance bank space. Then in the NBFCs, you have something like an Arman and Credit Access. So it's a huge basket which is available. Even maybe L&D Finance is microfinance heavy. So 5-6 names, I think, that should do well over 12-18 months. That's our take.
All right. Digant, thank you so much for joining us and giving us your view on the way the sector is likely to be. The good quality stocks have already hit a record high. Speaking about record highs, a big move is what we're seeing in the Nifty Bank, which we've been pointing out earlier itself. But today's up move is supported not only by the Nifty Bank, but a firm recovery in the IT pack as well. So we have, Tech Mahindra, which is doing well among the top Nifty gainers today. We have Infosys, which has recovered a fair bit from the lows, currently at the high point of trade once again, opened higher, thereafter saw a sell-off. That sell-off had been bought into. Right now, we're back around the higher end of today's trading range so far.
Even Tata LXC, it opened down 2 to 3%, and now it's up 5%. And here the numbers for sure were very disappointing, right?
You take that point. So that's about the IT pack and the Nifty Bank. And as we speak, in fact, 24,050. That's an important mark because the 24,050 mark is the 200-day moving average on the Nifty. The Nifty is around the 200-day moving average. Good time to get in the technical picks then. Mitesh, 24,050 was your first target on the Nifty, with the next one being around 24,200. Do you think now that we're close to 2450, there is a trade that may take you another 150 points higher?
Manav, I think that's the tricky part of the entire thing. You met one target, it's an important level. You hit the 200 average after a big decline. My idea is that I think, if you're not taking profits, I would still suggest take 30% or 25% off the table. Or even if you're not inclined to take profit because the trend is still strong, it is trade your stop losses to very tight levels. So on the Nifty, I would say now I think a good trading stop would be around 970 or thereabouts, and 5 points below that. And yes, I think eventually we will hit 24,200 and possibly even make an attempt towards 24,750, 800. Those targets are still open. But to know if the consolidation will start right now or some profit will happen right now is very difficult to say. So I think that's the way trading should be approached. The buyer should remain on the downside, and only you might want to lighten up 1/4 or maybe 30% of your positions.
All right, and your trade at 10 would be?
Yeah. I have a buy on Gas Authority with a stop at about 192.5 for targets of 204. And Kotak Bank is another one which I like. That's a buy with a stop below levels of 21.70 for targets of 22.65.
By the way, it'll be interesting to see the FII numbers, right? I mean, it looks like they are piling in big time. I think last week FIIs bought stock worth about 15,000 crores. And of course, I mean, multiples of that went out over the last 7-8 months. So it's a bit of a, I mean, the way the market is going, looks like they're stomping right back in. And of course, I mean, the other thing is this U.S. vice presidential visit. Apart from, there's a fair bit of symbolism with things like this as well, because, you've got practically a bit of a trade war, a very, very antagonistic attitude with the U.S. under the Trump administration to everything else, to all other countries. And in that scenario, the second top person in the U.S. coming for a visit to India, I think a fair bit of symbolism in that sense. For sure. 200 on the Nifty, 24,050. We'll take a quick break here. Manisha will be joining in with commodities and focus, and I'm sure gold will make a mention there. Stay tuned.
Welcome back. Let's turn our attention now to the commodity markets. Manisha is joining us in the studio. Manisha, gold prices, have they hit 1 lakh? If you go to buy now, go to the store?
Oh, well, absolutely, yes, Rima, and I'm going to exactly show you that calculation. Well, let me start with the international prices first, and we are trading at an all-time highs above $33.85 an ounce. I mean, this is an all-time high, and this is the 15th time that you have seen an all-time high above $3,000 an ounce. And my next plate shows you exactly that, the calculation for the Indian markets. So we have seen the gold prices open at an all-time high of 96,745 rupees per 10 grams. Now, this is the price for 24 carats. This is a price which doesn't have anything added to that. But I'm going to add 3% GST to that, because if you go out and buy gold in any form, 3% GST is basic. So with that, it's at 99,650. And if you're buying gold, you will have to give a minimal making charge, even if you're buying a coin or a bar and jewelry especially. So I've taken a minimal 10%. It's much higher at this point in time, but 10% of a making charge on that. And the gold prices are at 1,09,000 rupees per 10 grams. I mean, yes, it is 1 lakh now in the physical markets, and this is a basic price. If you're buying jewelry, anything more than that, you're going to be paying much higher than that. For the Indian markets, for most of the Asian markets, by the way, there are reports that the physical or jewelry buying clearly has been on a decline. I have been speaking to some jewelers, and they tell us that 30 to 40% of a decline in jewelry buying is what they have faced in last couple of months. And the exchange jewelry or the scrap jewelry really seems to be coming into the market. So people are, one, making profits, and second, they are selling their old gold, buying newer gold, or just selling gold because the prices are so lucrative at lakh rupees a 10 grams there. Now, the reasons why you have the gold prices running higher, one is, of course, the dollar index, which is trading at a 3-year lows below 99 now, has been one major absolute recipe for the gold prices to continue to go higher. And then Trump ordering investigation on critical mineral imports has added more uncertainty, and thus that premium. The third thing is about the European Union, where we saw an interest rate cut coming in on Thursday, and that is higher gold yielding. So we have seen gold buying reports coming in from the European Union. And then Trump's statement on firing the US Fed Powell has just added yet another more fuel to this premium that we've seen come in for the gold prices. I want to take you through a report card to show you on what gold prices have done. So on a weekly basis, we are up by 5%, 12% up in last month. And in this year, now we have surpassed on what kind of gains that we saw in previous year. So last year, the gains were 28%. We are up 29% in 2025 already. And the last 12 months have given you 45% returns in case of gold prices there. And the view from here on does look that the momentum will continue higher. Deutsche Bank, Goldman Sachs have talked about $3,700 an ounce and much higher levels if that level also gets broken. Bank of America, well, that level of 33.50 has been taken now, and Citi's talked about 3,500 by the end of May. $35 to $3,700 an ounce is a view that has come in from UBS, De Beers, Swiss Capital, SD Bullion. I was talking to them last week, and they said 3,500 by the month of May, and then for the month of June, July, August, in that quarter, perhaps some profit taking could come. But next couple of months, with the kind of uncertainty, you're not going to short gold.
Well, I think we had Ed Yardini this morning talking about 4,000 by the end of the year. Possibly. I mean, it was not a forecast, but he said, well, it's possible. Thank you very much for joining us. So gold very much at the center of things in terms of what's doing very well. The market here is doing phenomenally well as well, about 1% higher on the benchmark indices, Nifty Bank at a new high. We'll take a break on the other side. It's our special segment. It's the economy. Lata in conversation with Santanu Chakrabarti of BNP Paribas, and they discuss the quarter gone by for big banks like ICICI and HDFC Bank.
The toast of the market today is the Nifty Bank, and it has hit all-time highs. All three banks that reported numbers over the weekend, HDFC Bank, ICICI Bank and Yes Bank, are growing in the right parameters. Higher deposits, higher margins, higher ROAs, return on assets, and correctly showing lower metrics on the appropriate ones, lower costs, cost to income, and lower NPAs. Joining me to discuss the numbers and give us an idea of whether we should be buying back bank stocks at their all-time highs for the Bank Nifty is Shantanu Chakrabarti, the India analyst BFSI at BNP Paribas. Shantanu, good morning. Thank you very much for sparing time for us. I want to start exactly with this question. You know, the margins have risen now, but it is very clear that there are going to be 2 more rate cuts in the very least, given that inflation is expected to be below 4% for all the months of 2025, or almost all the months. So, do you think this lifting of the pressure on margins is temporary? And again, in the current quarter, we are going to see margins dip?
It's interesting you bring that up, Lata. I would invite you to think about this in a slightly different direction. If you look at what is really leading the entire easing that's going on within the space and what has really changed things, more than the first rate cut, it has been the backstopping of liquidity by the RBI that the system has proved the most sensitive to. Now, put yourself in the shoes of the RBI for a moment. Right now, there are external global uncertainties that we are looking at in terms of where tariffs will settle, whether that creates global inflation. Yes, one would expect US rates to come down, but there is an outside chance that it could go the other way as well. Now, if I am RBI and I can achieve my objectives through an instrument which is more flexible like liquidity, my immediate need to go for further rate cuts on an accelerated basis is probably not as high. It's only when the system stops responding to the primary instrument, which is liquidity, do I need to make further monetary realization. So I think probably the rate cut trajectory that is now being talked about, and remember the picture was very different even 2 months back, is now probably a slightly more accelerated timeline that people are talking about. We would expect slight pauses. Secondly, even if rates get cut more, over the next 6 months, you have to keep in mind that the easing factors have already started to kick in. HDFC Bank, for example, have cut FD rates by 50 basis points. Their savings rates is down to 2.75. So as the rate cut cycle progresses, the tailwinds on liability side continue to accelerate. So future rate cuts do not impact margins, point for point at the same level that they do in the beginning of the rate cycle. So both of these things combined, I would say that on margins as well as earnings growth for FY26, we would remain fairly constructive.
Okay. So you're saying that margins have bottomed and that they will inch up or stabilize at current levels?
Yes. Now, if I get 2 rate cuts within the next 6 months, maybe there could be another 5 basis points. I think the probability of that happening is low.
Okay, well, I can tell you a lot of people are on the other camp because obviously the real rate, the difference between inflation, 1-year inflation and current repo rate is more than 200 basis points, and there are a lot of people who will argue that it should be lower. Okay, what about loan growth? Of course, HDFC Bank loan growth is low for a reason. It's by strategy. But ICICI Bank also said that they were very careful with their loan growth. So do you think even if your margin per product is good, the volume is not going to take off so much?
No, Lata, this is where we have to look at what, again, the liquidity infusion by RBI has done. Fundamentally, as we know, liquidity transmission is also a factor on credit growth. So we are already getting much more sound outlook bites from management in the current quarter, and even the pre-quarterly releases, now the releases, we are getting better numbers than we would have probably expected even in February. So something has changed in March. And I would actually call for something like 13% system credit growth for the full year, which we have been calling for, which is not a low number. And it would translate into mid-teens or slightly better credit growth for most of the top banks. I mean, once again, HDFC Bank is a slightly different kettle of fish, but broadly,
But they have
those are
said,
healthy numbers.
no, I'm interrupting for a reason. HDFC Bank said that they will be with system credit growth in FY26 in the con call.
Yes. And that has been their stance for the last 3 con calls, actually. So they would be on system credit growth. But I'm saying for HDFC, for ICICI, for Axis, and all the other large banks, you will be 200 to 50 basis points above credit growth, would be our expectation.
Okay. So you're on a buy side on all these banks?
So HDFC, ICICI, and Axis was my pecking order, as you know. But ICICI, has accelerated a little faster than others, even though HDFC has. So the amount of upside available on ICICI is definitely less than HDFC and Axis, in our opinion. But what you have to keep in mind, Lata, is the vulnerable situation that the global economy is in. If for some reason the flip side of what we believe to be the easing argument plays out, then ICICI is a lot more insulated than the other two. I mean, they are obviously higher beta, HDFC and Axis, as things stand today. And that's why our ordering remains HDFC, ICICI, Axis. And
what you're saying is if rates are cut rapidly, maybe even they go to 5-quarter repo rate, then ICICI is better placed.
No, I'm saying that in case they have to pause rate cuts, if some of the liquidity interventions have to be wound back because there's global inflationary pressures or something like that, and there's more selling in India, if a scenario like that works out, ICICI is better protected than the other two.
Okay. No, actually, the arguments we are getting from economists is that there is a global disinflation. Not global, there is an Asia disinflation already underway. I mean, all Asian central banks are cutting rates, and plus Chinese goods that don't find a home in the US are going to look for home elsewhere. So disinflation is the theme that all economists are running with. Therefore, do banks become stronger buys or weaker buys now in India?
So generally, that should make banks a stronger buy, because the rule of leverage is that inflation decays leverage, and slower inflation or deflation would obviously give you greater value for leverage. And fundamentally, a lending business is just an asset ownership of leverage itself. Okay. So that part is fine. But the little thing that you have to keep in mind, Lata, is that there's also US inflation that you have to keep in mind, which matters in terms of US monetary policy, and therefore the carry trade, and therefore the degrees of freedom that India has on policy interventions.
No, I agree with you. We are entering into uncharted territory where you're going to perhaps see US inflation and Asian disinflation, and maybe uncharted territory in terms of interest rate differential between the two regions. But that discussion for another day. Let me come to the banking sector and how much you can extrapolate this to the other banks. Yes Bank also has reported good numbers. So would you want to bring that in the coverage? And are you therefore upping your forecast for any of the banks that's yet to report, like say Kotak, IndusInd, RBL?
So, in general, we prefer not to intervene into quarterly forecasts so close to the date. But obviously, Lata, one thing I want to make clear, that these margin numbers that have come out for both of these banks were not a surprise for us. We were ahead of consensus on NII on both of these names, and it's come in line with what we were expecting. Because, for example, the classic case is HDFC. You know this very well. I've been making the case for a counter-cyclical and somewhat counterintuitive benefit of easing for HDFC Bank, quite simply because the expiring liabilities, whether they are legacy NCDs or legacy TDs from the parent, are such high cost that it really doesn't matter much what you refinance with. You will always get a positive carry trade on those. So as far as margins are concerned, we have generally been slightly more constructive than the street, and I don't see a need for an intervention right away. We would rather reassess once all the numbers are out.
Well, one of the dramatic developments of the last 2-3 years has been ICICI overtaking HDFC Bank on several parameters, notably, important for investors like ROA. Do you see that continuing, or do you think that as HDFC Bank puts behind these long-term deposits that you're talking about, can it get its mojo back to the same ROAs as the best in business?
I think the same ROAs will come back, but the composition in terms of how much margin and how much cost to income is going to be very different. This is now a lower margin and a lower cost bank and in steady state, and that's what is going to play out. So will you get back to 2% ROA? Absolutely. And that is what our thesis on HDFC Bank has been predicated on. Now, just taking a slightly broader view on this, HDFC Bank is still the #1 liability franchise within privates in the country, right? The way I have put it always is that, yes, HDFC Bank has the more powerful engine vis-a-vis ICICI Bank, but HDFC Bank balance sheet is a truck while ICICI is a car. So pound for pound, ICICI has the cost advantage on borrowings. And even if I load in, appropriate retail scale and operating costs, it is very clear to us that ICICI is the leader as far as fully loaded cost of raw material goes in the sector. And therefore, their re-rating, gain of market share, ability to make enough ROE without taking too much risk is absolutely the sector benchmark right now. In HDFC Bank, I am saying that yes, it is a truck, but the truck's getting leaner every day. So on a relative basis, given where valuations are, once ROE reverts, say 2% and 17% over a few quarters. Now, how fast that happens depends on how fast CASA accelerates. It could happen by early 27. It could happen at exit FY27. It will depend on the liability trajectory. But once it comes back, then multiples will also re-rate back towards that. That has been the thesis.
What are your price targets for both?
I had for the longest time the highest target price on HDFC, and ICICI I still have about 22% as of the last close. I guess it's moved 1-2% today. But remember that all my target prices currently are set on third quarter of 27, right? So once the numbers are out and we'll review, then by mechanics there's a quarter of compounding that gets added.
Okay, we'll have to leave it at that, Shantanu, but I'll take a rain check from you to invite you after all the major results are out, including Kotak and SBI and the big public sector.
It will be my
banks.
pleasure.
Thank you very much for joining us. We have to wrap up on Bazaar on that note. Markets gung-ho at this point in time, especially Nifty Bank and the mid-caps. Chartbusters will take the action forward after the break. I think now he should call it.
It's
now happened several times in this.
Yes. I mean, last series was great.
He should have called it a day at that.
Yeah. Or the time when they won in Gujarat, against Gujarat at Narendra Modi Stadium. Just retire.
That's true. I think Gavaskar.
Yeah.
But yesterday was so one-sided.
So it was very one-sided. It was annihilation. But that was good, yeah. You needed Mumbai Indians to come up with a performance like that. Yeah. They needed a clinical performance.
Yeah, I can.
Let's see. Yes.
Makes the whole series interesting.
Rohit's form is typically sticky. So now